Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right. Hello. Welcome to the BOGART Effect. Today I've got Mike Camara with me, and we're going to be talking about 2025 strategy, some of the numbers, getting into some of the things that are changing, and really getting into some of the details on what we're seeing happen. I'm going to preface it, right, with the outcome of the election. Some of the numbers, some of the data that we're going to talk about today, there is a chance that it's going to change even in 2025. So, Mike, thanks for joining me today and looking forward to having a healthy discussion.
Yeah, likewise. Thanks, James.
So why don't we talk a little bit with, let's just say, the current known. Maybe first and foremost, let's get into like the 2025 tax brackets. Anything there that's material?
Yeah, tax brackets are going up slightly. So you're going to see an increase on where the 12%, 22, 24% brackets start and end. For example, the 12% bracket starting at $23,850, 22% bracket starting at $96,950, 24% at $206,700, 32% $394,600, and 35% bracket at $501,050. So slight increases on the brackets there.
Yeah, so it's nominally 3%, but just to clarify, the percentages are not changing. So it's still correct. 12, 22, 24, 32, and 35. It's just the thresholds that each amount is applying towards. And then standard deductions, they're changing, right?
Yep. Standard deduction basically is going to go up slightly for married couples filing jointly. The standard deduction rises to $30,000. That's an increase of $800 from 2024. And for individuals filing single, it's going to go up to $15,000 in 2025, which is a $400 increase from 2024.
And then head of households, I believe, is $22,500.
Yes, $22,500, an increase of $600 from 2024.
Yeah, perfect. And then probably the other one of big note is the annual gift exemption. I believe that's going to $19,000 per.
Yep, $19,000 per person, and that's starting again in 2025. And so basically, slight increase from there. That's a $1,000 increase. So it's $18,000 for this year, and so that's a lot of what our clients look at as far as gifting, trying to stay within that exclusion amount.
Yep. Now, there still is the ability to gift into 529 plans where you can accelerate that by 5 years. So you're actually able to do the 19,000. So this is 2025 numbers, the 19,000 times 5. And if you're married, you can do it times 5 times 2. So 190,000 can go in all at once. So for anybody, for example, that did the 5-year gift in 2024, well, you actually have the ability to true up that number a little bit where you can actually add the new annual gift threshold times whatever multiple is left off of that threshold. Anything else in terms of like the raw data there with tax brackets? I can't think of anything directly.
Nothing directly on the tax brackets, like we were, talking about with the election, the brackets themselves are not changing. And as it had been before the election, there was a high likelihood that those brackets were going to change in 2026 with the results of the election. And like you said, it can even still change for next year. We're likely to see an extension of the current tax code and potentially even some, like you said, some changes more to kind of a favorable stance on some of those. But yeah, we had originally been thinking that the sunsetting of these, was likely to happen, but with kind of the Republican sweep of both the White House and Congress, there's talk of that now being extended. And so we'll see how that goes.
And maybe just to elaborate a little bit on that, what we're saying is that the current individual tax rates were set to sunset at the end of 2025. And what we believe will most likely happen now, given the outcome of the election, is that sunset will be abolished. And so what we're currently experiencing will continue on. And the proposal is to have those made permanent. Just tangentially, while we're talking about it, right now, corporate tax rates are permanent as per the 2017 Tax Reform Act. The proposal from President-elect Trump is that they're talking about bringing corporate rates down by an additional 5% and also making that permanent as well. So a lot is going to change in 2025 and probably going into the future, but we want to at least have a good planning basis as we enter the new year here and talk about some of the things that we should at least directionally be thinking about. And then, of course, as we get a little bit later into the podcast, we're going to talk a little bit about how that impacts some of the strategy conversations going into the year. Why don't we talk, Mike, a little bit about IRAs, 401ks, some of the contribution limits. There are some changes that are going into effect this in 2025 that we hadn't seen before. Why don't we get into some of those numbers?
Yeah, on the topic of IRAs, the contribution limits for both traditional and Roth IRAs are going to be the same from 2024 and 2025. So that annual contribution limit for individuals under 50 is going to be $7,000. And then catch-up contributions is going to be $1,000 towards IRAs, both Roth or traditional. And again, many people think that I can do $7,000 to a Roth and $7,000 to a traditional. Keep in mind that the $7,000 is in total, so you can only give $7,000 in total between all traditional and Roth IRAs. And again, a catch-up contribution of $1,000 for individuals 50 and older, bringing again the total contribution limit to $8,000 for 50-year-olds and older.
Yeah, that's a great point, Mike. I do have a lot of households that I've encountered that think that we can do the IRA and the Roth. It's a combined amount that we get capped out at. Now, on the 401k side, any material changes there?
Yeah, catch-up contributions for 401ks in 2025 for taxpayers 50 and older is now $7,500. Again, the same as in 2024. Which brings the total contribution limit to $30,500. 2025 allows basically a regular contribution to a 401k of $23,500, which is a $500 increase. It was $23,000 for 2024. So basically, you can put in an extra $500 into a 401k with regular contributions. They didn't make any changes to the catch-up for 401ks.
Now, my understanding is in 2025, there's a new special rule that's happening for anybody that's the ages of 60 to 63. Is that correct?
Yes, that is correct. So as far as the regular catch-up contributions for people 50 and older, that it's not changing. But there is now a new catch-up contribution limit for those that are 60 through 63. Basically, they can contribute the greater of $10,000 or 150% of the 2024 catch-up contribution limit index for inflation for 2025. So basically, the maximum catch-up contribution that someone can make if they're between 60 through 63 is $11,250.
That's helpful. But it's only those 3 years, right?
Yes. And so if you're between 60 and 63, again, index for inflation, you'll be able to do a total of $34,750. Which includes the $23,500 regular contribution that you can make regardless of your age. But yeah, that's a really big difference there for those that, for lack of a better phrase, have kind of started late, whether working late, saving late, whatever. And so, getting that extra capability while you're likely in your highest income earning years towards the end of your career allows you to save a little bit more. And as the phrase says, try and catch up if you're, got started a little bit late for various reasons.
But just to clarify, so if someone's still working at the age of 64, their catch-up contribution limit goes back to the $7,500 amount plus the $30,000 of base. So I'm sorry, $23,500 of base. So it takes the total contribution amount to $30,500.
Yeah,
whereas
based on what
the current law, right? So, but yes. Somebody who's the age of 60 to 63, they can put a max of $34,500 in.
$34,750.
$750 in.
Mm-hmm.
And then someone who's 64 or older can put $30,500 in. So it actually goes back down once you turn the age of 64.
Yeah, it's just a 3-year window more or less, or from 60 to 63. So you just have that kind of window between those ages there.
Well, that could get confusing.
Yes. Yes. Kind of a strange way they did that. We'll see if there's any more changes that come about. We obviously see these things change fairly frequently, I feel like, over the last, 7-8 years with, Secure Act 2.0 and
Sure.
Secure Act and all that stuff with the changes to RMDs and stuff.
Well, admittedly, this is one that was originally going to go into effect at the end of 2023 for the 2024 year, but they pushed it a year. And I think it's probably because of tracking confusion associated with it. That's my personal opinion. What do I know? A couple other things, inherited IRAs. And this is one that's extremely dubious because first and foremost, how inherited IRAs are tracked really depends on when the person whose IRA it was passed away. So if they passed away prior to, is it 2019, Mike, or 2020?
2019.
Yeah. So 2019, you got to stretch out the inherited IRA distributions over the beneficiary's lifetime. Starting in 2020, a whole new set of rules went into effect. This is Secure Act, the first round of Secure Act, actually. And this one now says that any IRA or Roth IRA, if the person passes away 2020 or later, they have 10 years to be able to do the distribution.
Correct.
It was extremely confusing. This is another example of how they were very vague and unclear about how to administer these types of things. Admittedly, internally, we've had to build very complicated tracking reports just to be able to determine when somebody passed away, what the rules are. And then the other thing that was extremely unclear was if someone inherited an IRA from someone who passed away after 2020, did they have to take an RMD between year 1 through year 10, or could they take the whole thing out in year 10? Well, starting this year, we now have clarification on that. They gave us a little bit of grace from 2021 to 2024. But starting in 2025, if the person who passed away was already taking out their RMD, the beneficiary now has to take out an RMD amount that year as well, a minimum amount. Now, theoretically, that amount is much less than, say, for example, a tenth of the account if you were trying to just nominally equally disperse that account over 10 years. But the reality of it is that we have some of our clients that don't want the money. And because of it, they defer not to taking it. Well, this is a change that goes into effect in 25, that if mom or dad or whoever it was that had the IRA that you inherited was already taking required minimum distributions themselves, we need to take at least that amount. Now, Mike, correct me if I'm wrong, but if you were not, if mom and dad or whoever it was, the patron of the IRA was not taking RMDs, my understanding is that they do not have to take an RMD. They still get the full 10 years. Is that correct?
That is correct. Yes. So basically, that's the way the rule is as it's finally been clarified. Like you said, there was a lot of back and forth on that. So if the decedent or the person that had the original IRA was taking RMDs, just like you said, you have to continue that. If you don't, starting in 2025, the IRS will assess a 25% penalty on the amount that was supposed to be taken out. So obviously something you want to avoid as far as making sure to satisfy the RMD requirements. But yeah, there was a lot of back and forth on that. So we finally gotten some clarity at this point, and it's something that we're going to have to, continue to assess. And like you said, if it's something that really you don't need the money, but you got to take it out, you just got to look at that and how it affects you on a tax standpoint.
Yeah, I mean, it's kind of like, at least now we know the rules. We're not like the rules, but we at least know the rules. And because it was extremely ambiguous. And then there was a multiple series of private letter rulings around how to handle this particular issue. Again, now we at least know. I'll admit.
Yeah, we got the clarity, I think, pretty recently. What was it, back in July that we finally got this clarity? So it's not like we just got this back in January. It took a while for all this to manifest.
So real quickly, you mentioned a 25% penalty on inherited IRAs. That's actually a new rule too. It used to be 50%.
Used to be 50.
And they've now revised it down to 25% starting next year, right? So it's important to note that we don't want to have to pay a penalty ever. At least it has come down a little bit. But tracking this required minimum distribution piece, especially if you've inherited an IRA, is extremely important to do, simply because we do not want to be in a position where we're paying that penalty.
Absolutely.
Right. So let's transition, Mike, and talk a little bit about how this impacts some of the strategy work. And probably first is easiest to talk about is estate planning, because I don't know about you, but I have a lot of conversations with clients around estate planning. And the main driver there, to be perfectly honest, is right now the estate tax threshold is, in 2025 is going to be 13.99 million. So call it 14 million, right? Times 2. So that essentially means that we've got $28 million. If we're under that threshold, it does not matter. We do not have to file a federal estate tax return, and we don't have any taxes associated with that level of an estate. The component that creates a lot of discussion for some of our clients is that law at the end of 2025, as it's currently written, is going to go back to 5 million indexed up for inflation. Now, yes. Kind of coming back to what we said at the beginning of the podcast here is, I believe that there's a high probability that we're going to get that estate tax exemption kept where it is and probably continuing to index up from the 13.99 million number. So I don't believe that we have the risk that we might have had prior, that the threshold was going to come down. For anybody who's been listening to our podcast, I'll admit, I didn't really think that there was a ton of a risk of that in the base case, but again, it's current law. So we have to be mindful of current law. But this is an area where we plan for the known and then ultimately adapt for the environment based upon the changes that we encounter. I would tell you that I'm not rushing to get to a lawyer's office right now, anticipating that reset. I believe that we're going to see it most likely stay where it is, if not go up. And because of that, I'm counseling clients to be a little bit patient, at least in the beginning of the year. If we don't see material momentum in terms of what it's going to do, then sure, maybe we can. But I don't want to go spending a whole bunch of money modifying trusts and doing some convoluted or complicated estate planning strategies that we may or may not need to do. Now, if you're over the $28 million threshold, frankly, we should have already been having that conversation with you.
Yes, absolutely.
And
the problem I have if you're at that, and already would have gone in front of that. But yeah, I agree that basically, with that, a lot of people were anticipating that law change or the sunsetting of that, and we've already been talking about getting in front of estate attorneys. And like you said, there's cost to that to be able to draft the necessary documents. But at this point, kind of advising to maybe just sit back a little bit and not, like you said, rush into that at this point with the direction that the election's taking things now.
Yeah, I couldn't agree more. The other big thing that we have a lot of conversations around is Roth conversions. And yes. Maybe just a quick explanation. There's two ways of getting money into Roth IRAs. One is via a contribution, which an individual is only able to contribute to a Roth if they make under a certain income threshold. I believe the number is $244,000 for joint. Don't quote me on that. I believe that's to be correct. But the point is if you make over that threshold, the only way to get money into a Roth is with a conversion. There are strategies, for example, of what we call the backdoor conversion, where we can put it into an IRA and immediately convert it. It makes it tax-free. There's the mega backdoor conversion, where we can put money into a 401k and then convert it out. But the reality of it is for a lot of our clients who are nearing retirement, in retirement, or later stages of retirement, they have large pre-tax assets, so IRAs or 401ks. And because of that, that means that they're most likely going to have their own required minimum distributions when they turn either the age of 73 or 75 that are going to probably be higher than what they were hopefully, ideally wanting to spend. And it means that they're in what we call tax prison, tax purgatory. It's just an unoptimized environment. So we're trying to get ahead of that conversation. And one of the ways to manage it is with Roth conversions. And what that means is that we will convert a piece. It doesn't have to be all of the account, but a piece of the account. We get to determine the amount. We pay ordinary income on it now, and presumably we're in a lower tax bracket now than where we're anticipating to be in the future. And so all of those monies that we convert from the IRA over to the Roth grow completely tax-free. And when we hit the age of required minimum distributions, there is no required minimum distribution on a Roth IRA as well. So a lot of the discussions we have around tax management and tax optimization really do come into referencing this Roth conversion strategy is one of the main ones, honestly, right, Mike? I would tell you that I had a lot of clients that felt pressure to do larger conversions with anticipation of at the end of 2025, tax rates were going to sunset back to what they were, which was about 3% higher. I'd say, from a planning perspective, I still think it's extremely important to look at where are your assets at today? Where are we projecting them to be in the future? And the larger driver for all of these conversations really comes back to what is someone's withdrawal rate? Like what are they drawing off of their portfolio? Because if someone was withdrawing, let's just say 3%, well, that portfolio is going to continue to grow and continue to compound and most likely do it very, let's just say relatively aggressively in that RMD phase of their lives, which is going to cause them to have to pay bigger tax bills. Versus someone, for example, that's spending 6% or 7% of their portfolio. Well, candidly, this whole conversation around required minimum distribution is completely null and void because you're most likely drawing more than what you're required to take out, and it's not a problem. And by the way, for most of Americans, this whole RMD component is really not a huge issue. But for those individuals who have been saving their entire career in 401ks. They have a pension with a lump sum option that they take the lump sum option and roll it into an IRA. Well, in most instances, at least with our client base, it does create a tax inefficiency that we're wanting to do here. All right.
Yeah, exactly. And I think, part of what we want to do is planning and running those numbers like you described to kind of see, what's your withdrawal rate? What's the numerator, denominator, how much you have versus how much are you taking? Factoring in things like Social Security that's eventually going to kick in for most people, things like that. And then, if you are running that risk, and it's pretty clear in the analysis, especially when we run some fairly conservative investment growth numbers, that you're going to likely fall into that trap. You really need to look at that and consider, doing Roth conversions. Just like you said, with the new, potential tax law, extensions and things like that, don't have to be quite as aggressive as we may have been looking to do if the election had gone the other way. But still, it's going to make a lot of sense for a lot of people, I think. And when you're looking at also your situation, we see, like we talked about, what the tax brackets are changing, standard deductions, things like that. But really, it's also what is changing with your situation. The example being is that, I've got a lot of people that are retiring at the end of this year, and they're going to have basically their income drop fairly significantly. And if they're fortunate enough to have non-retirement money, like savings or brokerage accounts or things like that, we might be utilizing that for income next year, which is not going to affect their marginal tax brackets or earning tax brackets typically, or at least not too much. And so that's going to leave a lot more room for Roth conversions compared to this year when they're at their highest income earning years at the end of their career. Your last year, if you're retiring on December 31st of this year, your last year of work, you're probably making your highest salary that you've ever made. And then basically there's also people that have retired that may have incentive programs like RSUs that vest or non-qualified plans that have been paying out that might be, drying up now. And so these taxable events are going away. And if you, again, have non-retirement assets you can utilize to live off of, next year might bring a lot of different opportunities compared to previous years, even if you've already been retired, to have some capability to do Roth conversions in a much lower tax bracket you'd be able to do otherwise based on, previous years of income.
Bingo. Yeah. And the other thing I'll add is how your portfolio performs can also have an impact on this conversation as well. We're coming off of 2024, which by all definitions have been a fantastic year.
Yes.
I tell you, I won't get into average portfolio performance for our customer base, but when you're talking double digit 15 to 25% returns in a year and your portfolio is having such a fantastic year, well, and especially if a lot of that growth has happened on the IRAs, this problem, albeit we might be managing it on an annualized basis, is only continuing to get worse.
Yes.
I understand these are bougie problems. These are great problems. And I wish everybody had these problems. But the reality of it is that this is exactly why, to the comment that Mike made earlier, it's so important to have a plan that's a living document. It's organic in nature. We're updating it. We're revisiting it because how the portfolio is positioned, not only in terms of value, but that withdrawal rate is imperative to do this assessment and really run the numbers and have that analysis as a baseline. Because candidly, if we don't do it and we ignore it, and then all of a sudden our effective tax rate materially moves up in a couple of years once we turn on to required minimum distribution age, well, we're going to be very remorseful that we didn't do something when we were in these lower effective tax rates now.
Absolutely. I'll just throw in, I've had clients come to me much later on after being retired for, in some cases, 15, 20 years. and they had a lot of non-retirement money. They spent it all down, did not touch any of their IRA money. And then they get into their 70s and suddenly they're just shocked at how much their IRA grew over that time and how much the IRS is now making them take out. And again, people think, hey, I want to save as much taxes today, save taxes now, not thinking about the future. But when we're, as financial advisors looking at this holistically, we got to plan for the future. We got to look at what the long-term impact is, not just saving taxes today, but saving taxes for your lifetime. And another piece of that is, as we were talking about inheritance, for some people, this is important to make sure that, their beneficiaries, their loved ones are set up in the best possible way. Roth conversions can save people taxes for themselves long term. But if they don't, if they unfortunately pass away after doing a lot of Roth conversions before living long enough to kind of see the benefit of it by R&D age, well, that inherited money will go as Roth money to beneficiaries. And while that still is going to be, subject to the 10-year basically drawdown, it's already taxed, estate taxes aside. They can pull that Roth monies out with no taxes. They can let it go basically for 10 years and then cash it all out. And it's not going to be a tax burden for your beneficiaries. So what I always like to say with Roth conversions is someone's going to save on taxes with that. It'll be the client if they live long enough, likely, and they're, falling into that R&D trap. If they're unfortunate that don't live long enough and they've done all these taxes on the front end, then their beneficiaries will benefit from the taxes that they paid with the conversions.
Bingo. So much color in what you just said, Mike. The thing that I would tell you, and this is directly related to whether it be you who's doing this or your children, the effective tax rate still becomes the conversation when we're looking at this analysis. And I'll just assign numbers here, but let's say, like Mike just said, you retire at the end of the year, you go into 2025 with no ordinary income items coming in. I mean, essentially your tax bracket is zero, right? I mean, it never ends up being that way because of dividend income and whatnot. But the reality is it's a very, very low tax bracket. But let's say, and again, I'll assign numbers, you're 60 now. When you turn 75 and your required minimum distributions come on, let's say you have enough non-qualified or brokerage account money to fund the next 15 years. So you just let the IRAs continue to grow. Well, all of a sudden, we're projecting that you're going to be in the 25 or 26 or 27% effective tax bracket. Effective tax rates. That's what you're paying, not the bracket. Theoretically, in that scenario, you're in the 35% bracket, right? So what that means is that we had all these years where we were, let's just say 10% low, and then immediately jumping up to, a mid 20% number. That's extremely inefficient. And the number one resistance point, which I'll admit, I don't like paying taxes. I don't know a whole lot of people that do, to be perfectly honest, but the number one point that becomes very challenging is writing that tax check today for something that you won't materially benefit from years from now. And as you mentioned, you might never benefit from. It is the reality of it. But your beneficiaries absolutely will. And so the analysis really comes down to what's our effective tax rate today? What are we projecting it to be in the future? Discount that back to now, and boom, we have an inflection point that makes a lot of sense as to where we should be looking at for doing these Roth conversions. Mike, I know we're kind of rounding towards the end, but I think the other thing we wanted to talk a little bit about today is going into 2025 insurance costs. I know we were talking a little bit about before the call, but gosh, they're going up. I mean, across the board, whether it's home insurance, auto insurance. What comments you have there?
Yeah, mainly just to kind of shop around. We're starting to see a little bit of competitiveness between, the various insurance companies with rates. Just about everybody, if not everybody, has seen their homeowners insurance, their car insurance, in some cases go up 50% per year over the last, couple years or so. But, shopping around is really what we advise here. Just kind of look around, look for comparable coverage, see what you can save as far as that goes. And basically, it's a little bit more competitive. Like me personally, like I said, I bought a car. My insurance provider at the time tried to double my premium, contacted my agent. He shopped around. He was able to get me pretty much the exact same coverage with basically only about a 10% increase. So, taking the time to shop around, it's a pain to switch and, do all that stuff, but it can be significant savings, especially with how much we've seen these insurance costs go up in this inflation environment that we're kind of getting out of now over the last couple of years.
Yeah, bingo. And I'll tell you, in Texas, for me, I was with Nationwide. They completely eliminated my coverage. So then all of a sudden I'm having to go shop it to the open market. And it was pretty surprising, to be honest, on how different some of the carriers were. Cause there's some that don't even, like in Texas, don't even want to be there. And it's, we're seeing the same thing in areas like Florida. And I think that's only going to get worse, to be perfectly honest, in certain areas where it's going to become extremely expensive and extremely difficult to fund some of these insurance policies.
Sure.
All right. So absolutely. I know, just kind of recap our podcast today. The reality of it is that we're most likely going to see some change with the new administration coming in. Currently, the tax brackets have inflated up a little bit. Not the percentage rates, but the dollars assessed for each rates have inflated up. We did see IRAs and Roth IRA contribution limits stayed the same. 401k contribution limits went up a little bit. The annual gift tax threshold went up by $1,000 each. State tax thresholds went up nominally about 3%, so just under $13.99 million each. So
yes.
All in all, everything's indexing up. I do think that we're going to see some meaningful tax policy change as soon as President-elect gets sworn in the end of January. And, really, it's one of these things where you need to have a plan, need to have a financial advisor, need to be constantly working the plan and assessing what those implications are. If you need any help, please don't keep us a secret. We absolutely love to work with your friends, love to work with your family, and we're very willing to accept referrals. Mike, thanks for the time today. It's been a fantastic podcast, and looking forward to connecting with everybody in 2025.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.